Welcome to our 2016 webinar series. This year, timing is everything. This year, we'll be telling your client stories just when you need to hear them and share them with your clients. After all, when you tell a story, makes all the difference. If I told the Three Little Pigs to a group of 5-year-olds, it would be a fable. If I told the story of the Three Little Pigs to a group of general contractors at a conference, it would be a case study. If I told the story of the Three Little Pigs at a summer campfire with a bunch of preteens, it would be a scary Cujo story. And if I told the Three Little Pigs on a first date, well, there probably wouldn't be a second date. Each month, we'll tackle fears your clients have about income security and wealth preservation using innovative and creative insurance solutions. This month, we'll recognize the diversity in insurance, specifically for women, as March is Women's History Month. Each month's series will last about 50 minutes, and you must be logged in for the full 50 minutes in order to receive CFP credit. And since timing is everything, please ask questions as you have them by typing them in. We'll do our best to answer them as they come in. Today's story will be recorded and will be posted on our website within a week in case you missed any of the plotline. And throughout 2016, like the saying, the more you read, the more you know. The more you watch, the more CFP credits you'll earn. You can get 8 credits, 1 for each month. Today's storyteller reads a lot, constantly monitoring the insurance and financial services industries to ensure your clients are getting the most up-to-date recommendations. He joined LLIS in 2003 with his CFP and MBA, and has been writing the LLIS story as president and CEO since 2013. And now to tell the story of how men and women are different, when it comes to underwriting, that is, Mark Maurer.
Thank you, Claudia, very much. And thank you all for tuning in today. It's exciting to be here at the start of 2016. I'm not exactly sure where the first part of the year went, but we're already rocking and rolling on the first part of the year, and so I'm excited to be here with all of you for our first webinar of the year. So you may be wondering, Mark, you know, this is Women's Month. This is Women's Month about insurance, and so you're wondering, what makes me qualified to speak about this subject? Well, I have been married for almost 16 years, or maybe 17 years. I should probably check on that. But that means that I know still almost nothing about women. And yep, I pretty much know still nothing about women. But what I do know is I know a little bit more about how women are different than men for insurance. And isn't that why you all tuned in today? Sorry guys, no great life lessons out there, just about insurance. So we're going to talk about life insurance and how women differ than men. Pregnancy and how that impacts underwriting. Women in disability insurance and long-term care insurance. We're even going to touch on annuities and how males and females get different coverage and benefits. But first, let's talk about life insurance. As I was going through this, you can tell when the last time that I watched morning television was, because I talked about Willard Scott congratulating people on their 100th birthdays, and people here in the office laughed and said, you got the show wrong, Mark, and you also, he think he's been retired for a couple years. But women live longer than men. It's not just, facts based on Good Morning America. It is statistical data. And so to be really sure why women live longer and so they can pay lower premiums for life insurance, we go to the super exciting CSO tables, the Commission of Standard Ordinary or something like that, but actuarial tables studied by people in big rooms with probably glasses and kind of dark lights overhead, where they just crunch numbers. And what the CSO tables tell us is life expectancy, not how long someone's expected to live, but what is the point in time when a person of certain age and gender, at what point in the future will half of the people in that cell today be alive and half will be deceased? So the CSO table, the life expectancy, which doesn't really mean how long we expect you to live, but that word is life expectancy, is what they come up with at the 35 for a female, age 35 today. Her life expectancy is 80.8. That means half of the 35-year-old females that are alive today will be deceased by age 80.8, and half will live past age 80.8. A female age 45, life expectancy slightly longer, 81.3. And what you'll see is that as time goes on, it sort of makes sense. At age 65, some of the people between 35 and 65 did die. So at age 65, the likelihood of that female still being alive is longer than when we go back to age 35, because that person is now, I am 65, I did outlive some of those other people. So now that I'm 65, my life expectancy is even longer, 84.2. And if I'm 75, my life expectancy jumps to 87.1 from 84. How about age 85? Wow, I'm 85. For 50 years, I beat all those other people compared to when I was age 35. So now when I'm age 85, it's very likely that half the people age 85 now won't make it to 91.7, but the other half will. Well, what about for men? Wah, wah. Well, men's life expectancy isn't quite as long. At age 35, there's about a 4-year difference. So when we go out to age 75 or 80, 75, there's about a 2-year difference. At age 85, heck, when you're age 85, you've done something pretty well for the last 85 years because you made it to age 85. But when you're 85, there's not a big difference between men and women as far as life expectancy. So let's take Abby and Alex. They're twins. Using their life expectancy number, Abby at age 50, half of the people age 50, females, will die before age 81.8. I know this is happy, exciting stuff, but this is life insurance and this is how it's priced. It's not morbid, it's facts. Abby, age 50, hopefully she's in the other 50% that's going to live past age 81.8. Alex, her twin brother, so we made them twins, so they're exactly the same age. His life expectancy, using that word again, not how long we really think he's going to live, but half the people age 50 today will die before age 77.9, half will live longer. Now, we took the life expectancy calculators, which all it does is give us, all the CSO tables give us is that number. And we built a second one that says, okay, that's half, that's the average. For advisors, for myself, I like to think I'm better than that 50%. Financial advisors with clients who have access to healthcare, can afford basic staples, can see a doctor when they need to, probably take better care of themselves than maybe average people. What if I want to build in 50%, if I'm looking at the longevity expectations of Abby and Alex, building, age 81.8, they probably are going to live longer than that. That seems like a pretty short time horizon to me. What if we say that Abby and Alex, I want to be in the population where 80% of the people have died. So I'm going to assume that Abby and Alex are better than the average. I want 80%. I want to make sure, what's the now that they're age 50, I want 80%. Well, that's Abby's age 92 and Alex's age 88. Nope. Abby and Alex, they kind of look like they're outdoorsy people. I bet Alex was, chopping some wood for the fire a couple minutes ago, and And you know, Abby was out. Looks kind of like it's cold where they're coming from, so maybe she was out shoveling snow a little bit before this picture. They're in great health. I want the 90%. I want to make sure that they're sort of in the top 10% of life expectancies now at age 50. I sort of need to plan for age 96 for Abby and 92 for Alex. Look at the life expectancy. So life expectancy isn't really what we think. How long do we think somebody's going to live? That's just when are half the people who are alive today dead, half the people who are alive today still living. A big difference when we say that your clients, a lot of people are better than average. Now, we're looking at the differences in the life expectancies, men and women. That's what we're talking about, men and women. Why do I think men's life expectancy is shorter than women's? Well, I am male, so I would say that I know a little bit more about male than, well, maybe the average woman, but probably not. Women pretty much know a little bit more about everything than the rest of us. So why do I think that is? Well, especially when we're young, guys do things like this. And Taylor and Claudia, who helped me put together this presentation, I said, can you Google some pictures? Maybe is there pictures of guys doing something dumb? Apparently that blew up the internet. Taylor broke Google because there were so many pictures of guys doing dumb things. And so why are our life expectancies shorter? Because we do things like this. We apparently plug in a griddle in the middle of the pool and float the extension cord on flip-flops in the water. That's what guys do. We say, you know what, I'd really like a hot bath. This seems like a good idea. Who's in that tub? Guys. Who's on the sideline laughing? Women. Guys do these things. So that's why life expectancy for men, in my humble opinion, tends to be shorter. Maybe that's not all the reason. Maybe health and some of those things have to do with it too. But remember, the gap narrows as men get older. We have a bigger difference for those 35-year-olds, almost 4 years life expectancy difference. But then once we get out to age 85, these guys didn't make dumb decisions. You would not find any one of them sitting in a bathtub over a fire. They just wouldn't do that. So now that they're getting older and older, we have less of those things that can happen. Now, what do premiums look like? I told you I'm going to talk about life insurance. Women live longer. So what does that mean as far as dollars? Well, for a $500,000 10-year term policy, a 35-year-old female would pay $184 per year for a 10-year term policy. Now, let's say she has a 10-year older sister who's 45. She'd pay $379 for a $500,000 10-year term policy. The third sister, $748. The fourth sister, $1,695. So when this lady is this age, that's what that term policy is going to cost. Now again, because men do things like this, not only because we do things like that, but because we do things like that, our premiums are higher. Now, I said that the premium difference is greater when we're younger. Our life expectancy difference is greater than we're younger. And it looks sort of opposite here, because at age 35, the premium difference is 184 to 209. You'd say, Mark, that seems counterintuitive. You just told me that the life expectancy difference is greater when they're younger, and that's true. However, what we're covering here is a specific period of time. And so a 35-year-old female or male has a 10-year term that's covering him or her between age 35 and 45. Chances are nothing's really going to happen to either of them at that point in time. It's a very short, very young period of time. We see the widening as the client gets older. Let's go out to age 65. Now is when we start having more of that difference because our life expectancy is shorter. When you're 35, your life expectancy is still out in the 80s, whether it's 79 for a man or 82 for a woman. Between 35 and 45, we aren't worried about any of those. Chances are very small. When we get to 65, however, in a 10-year term, we're looking at a period between age 65 and 75. Now, that's a very real period of time where some of those men who are going to be 2 or 3 years shorter life expectancy than women might have things start happening to them. I'm very lucky in that when I went through this, I can't come up with any of my friends who have died between age 35 or 45. I just haven't had any. But I do know of family friends, people at church, who have died between age 65 and 75. And so there's a much bigger difference in the premiums here, because now we're starting to look at what period of time am I covering. The 65 to 75, that's when I, as an insurance company, do expect to have some deaths. Between 35 and 45, I really don't. So whether it's male or female, I really don't expect to have much of a claim. Now let's go back to Alex and Abby. Instead of a 10-year term that increases, and like I said, we're only covering a short period of time, what if I want to cover their lifetimes? A $500,000 no-lapse guarantee universal life policy. With the no-lapse guarantee universal life policy, the premium is set today, guaranteed premium, guaranteed death benefit. So as long as they pay the premium, no ifs, ands, or buts. So this is the closest thing as I can get to pricing in when with the difference between a male and a female to pay out $500,000 to their beneficiary. So Abby, age 65, $8,630 per year. Alex, same policy, same age, same underwriting class, $10,500. What does that mean? The insurance company says, I'm going to pay out $500,000 at Abby and Alex's death. So what premium do I need to collect to have that $500,000 available when I pay it out? This means that I expect Abby to live longer, and so I'm going to collect premium a little bit longer period of time, so I don't need to collect as high of a premium to pay out that $500,000 to Abby or Alex's beneficiaries. Family history and underwriting. This is something relatively new. And so there is some difference between men and women when it comes to underwriting, not only just because we have different parts, but even in the family history. It used to be if someone had a history of heart disease or cancer in their family, underwriters looked at that the same. If someone had any type of cancer, that was considered in the charts. Do you have a family history of cancer? Well, Abby says, yes. My father had prostate cancer. The underwriter said, well, do you have a family history of cancer? Abby said, well, but I don't have a prostate, so I can't really get prostate cancer. And over the course of time, underwriters have started to agree with Abby from that standpoint, in that certain types of familial cancers are not considered if they're gender opposite. Meaning, if Abby applies for life insurance and her father had a history of prostate or testicular cancer, with some insurance companies, that doesn't impact Abby's rates at all. Similarly for Alex, some insurance companies say, Alex, you're applying for insurance. You have your mother had breast cancer, ovarian cancer, cervical cancer. Those things are not considered male-specific cancers, so those aren't considered in your underwriting. What I find interesting is that breast cancer can be male or female, but many times it's included in female types of cancer. So it's not always a perfect science, and there are some things that still might be considered, and it's not all insurance companies. But I think it's very interesting that the insurance industry has looked at this, and they're always kind of looking at things to say, family history of a gender-specific cancer makes no correlation to a child of the opposite gender. And until we get to this point in medical science, pregnancy is still an issue that only impacts women. Now, if any of you ever saw Junior with Arnold Schwarzenegger, Danny DeVito, and Emma Thompson, I apologize. If I could give you those 2 hours of your life back, I would. But, well, I probably can't. My mom always told me if you can't say something nice, don't say anything at all. So let's look at pregnancy and underwriting here, specifically in term life insurance. In the first trimester, there may be some other issues involving pregnancy, morning sickness, odd cravings, but from an underwriting standpoint, for life insurance, the first trimester is really not an issue. There are no insurability complications, obstacles. In the second trimester, though, depending on this pregnancy or previous pregnancies, things can get a little more complicated. Some insurance companies, when you get into the second trimester and you have multiples, twins, triplets, some insurance companies will consider an application. Some insurance companies would postpone until after birth. If there are any complications with this pregnancy, or some companies, even if the client has had no issues with this pregnancy, but has had issues with previous pregnancies, then the insurance company may postpone until after the babies have been born. Gestational diabetes. When a woman is pregnant, sometimes she can develop gestational diabetes. And so if she were to have the pyramid exam and the blood draw, it would show elevated blood sugars. And so she may not get the best, the fairest shot at the underwriting, because her levels are elevated now when they're normally not, and may go back to normal as soon as she's given birth. And the third trimester, many insurance companies will postpone an application. Now, we find out a lot of information. Have there been multiples? Any complications? Gestational diabetes? And we contact insurance companies to find out if they will or wouldn't consider somebody for coverage. So we do a lot of work to find out, when we get into the third trimester, which insurance companies might accept an application on a female pregnant client, or which ones might not. But that's part of what we do here, is to find out who will, who won't, and knowing that even in the third trimester, cholesterol levels can be very elevated. And so there will be your height and weight, or a woman's height and weight is going to be different when she's pregnant than, for the most part, can't say always, but height and weight be different than when she's pregnant than normal. And so what the insurance company has is a snapshot, or this one point in time, to get someone's blood sugar readings, height and weight, cholesterol. So even if an insurance company may offer coverage, it may not be indicative of what rate class she may normally qualify for, when all of the other readings would be normal. And so that's something we look at. We can go ahead and submit the application, knowing that some of those might be adjusted, or many times insurance companies will want to postpone an application until after the 6-week postpartum checkup, where sort of all of those things have worked themselves back down to normal levels. And then after delivery, well, we have this cute little baby, which I still think is photoshopped. Just looks too cute to be real. And then what about after delivery? Well, after the 6-week postpartum checkup, most of the time insurance companies will If they've postponed a female applicant, that's the timing when they are ready to go ahead and collect new labs, the application, all of that. But gestational diabetes can still be an issue even after the pregnancy, even after the 6-week postpartum, even after the blood sugar levels have gone back to normal. And so about a year and a half ago, we had an advisor's client who had gestational diabetes while pregnant, was no longer pregnant, her levels or her labs were back to normal, and had gone to someone else and gotten an approval that wasn't very good because of the history of gestational diabetes. And her point was, but I'm not pregnant now. My levels are fine. Does that sound normal? Well, and with some companies, it is normal. American General would say someone, assuming everything else is in the preferred plus category, as long as it's been completely resolved and with normal A1C levels on the current paramed exam, they can consider someone for the preferred plus, the very best rate class. 3 other companies said, we can't do our super preferred and we can't do our preferred, but we can offer the standard plus or select rate class because an applicant with a history of gestational diabetes, they believe has a future increased risk of diabetes in the future. ReliStar and Columbus Life said standard for the exact same reason. Because of the history of gestational diabetes, this person has a future increased risk of diabetes. What they're working on here is the law of large numbers. Not that the client who'd we'd helped may be more likely than someone else to develop diabetes in the future. She might say, I'm a vegan, I only eat sprouted grains and grasshoppers. You know what? I'm not going to have any of that. I'm perfect health. But to an insurance company, they use the law of large numbers. And if I have 10,000 applicants with gestational diabetes and 10,000 applicants are insureds without gestational diabetes, my odds are higher in the first pool with gestational diabetes that they are going to, that some of them will develop diabetes in the future. I don't know which one. I can't say it's you, or you, but on this large, the law of large numbers says more likely to. And so some insurance companies are more favorable with that than others. So let's talk about women and disability insurance. Covered a lot about life insurance and some of the different underwriting issues. With life insurance, or with disability insurance, we talk about morbidity, which is the proportion of illnesses in a population compared to mortality. And that's the incidence of death in a population. So it seems almost paradoxical that women would pay more for disability insurance coverage than men. I just told you they're likely to live longer. As many of you would argue, they're the smarter sex. As on a whole, they take better care of themselves, and they tend to be more cautious than men. I just told you. There were no pictures of women doing dumb things on Google. There were 4.2 billion of men doing dumb things on Google. So you would think that they'd be less likely to incur a debilitating injury that would prevent them from working. They pay less for life insurance because they live longer. However, statistics and disability insurance company claims clearly show that women are 40% more likely to become disabled due to a long-lasting illness and are therefore more likely to file a disability claim. So accordingly, insurers charge women on average about 60% more for disability coverage than a male of the same age, same occupation class. And it's based on claims. 1 in 4 women will experience some sort of complication that could prevent them during pregnancy or lengthen the time of post-pregnancy recovery. And like I said, until medical science lets me have a baby and Arnold have a baby, maternity, pregnancy, childbirth is still only a woman's disability claim possibility. Men suffer from depression too. However, it is much more likely to occur in women because of some of the leading causes are related to biological issues with women, such as premenstrual and pregnancy complications, and postpartum disorders. Although many insurers won't cover depression or limit its coverage, it can often be linked to a biological issue which may be covered. Autoimmune disorders. While both men and women can suffer from autoimmune disorders, women are much more likely to develop chronic conditions such as lupus, Graves' disease, chronic fatigue, multiple sclerosis, and inflammatory bowel disease. And many of these conditions can cause long periods of disability. These are things that won't kill you. Mortality talks about heart attacks, strokes, things that mortality is worried about somebody dying too soon. Morbidity talks about someone not being able to work, needing care, developing an illness. Women are smarter. They figured out how to live longer. That's just, somehow they did. But from a disability claim standpoint, and even here, partly because of biology, there are things that women, only women, can have issues with and have a disability from. The science is still out on why women tend to suffer more chronic diseases or depression. However, the only thing that matters to the insurers is the claims and statistics that they have decades of track records of tracking all of this. Track records of tracking things. I could probably have done better on that, but you got my point. So no matter how well a woman takes care of herself and may not have any of these issues today, may not ever develop them in the future, the premium for a woman is going to be higher than a man. So, Abby, she is 40% more likely than Alex to become disabled, resulting in about 60% higher premiums. And so as I was working on this month, I actually happened to have a husband and wife who were my perfect case study. I couldn't have made this up if I wanted to. Victoria and Norm are both age 35, and I changed their names to protect the innocent because they are analysts for some entity. They're probably listening to me right now, but they're both analysts. They both happen to be age 35. Because they work for that entity that may be listening to all of us right now, they have the same employer. They have the same functions. They have the same salaries. It was fantastic. So perfect for this because I didn't have to make them up. They were my case study. They both were doing the same functions because they were government employees. They both had the exact same pay scale, same benefits. It was perfect. So what does this look like? They both have a $125,000 salary, 40% group coverage. So they were both eligible for $4,415 of supplemental monthly disability benefits. Norm, his premium, $1,733. Victoria's premium, $2,633. Why this works so well is that there's no other issue that makes those premiums different. Same benefits, same age, same occupation class, same salary, same group benefits. I could have just made one up, but it was so perfect that they happened to be asking me for disability coverage a couple weeks ago. The only thing different here is their gender, which is a 52% increase on Victoria's premiums than Norm's. So it worked out again really well that I could isolate all of those other variables because everything else was exactly the same. The only variable here was their gender. Now, moving from Norm and Victoria, who are 35 years old, we have this lady. She's probably more than Dave and Victoria put together. For all of you, I'm sure that you have seen that in the recent past, long-term care insurance premiums. Oh, I had one question come through. Victoria Norm example, what about family history? Does this play into disability insurance premiums? And the answer is no. With life insurance, it makes a big difference. With disability insurance, I haven't seen where the family history can come into play on the pricing. The nice thing about disability insurance is that we don't have all of the different rate classes that mostly we do on life insurance. Super preferred, standard plus standard. Most disability policies have a standard rate class and then maybe ratings if there are health concerns. So that's one nice standpoint. But as far as family history on the disability insurance premiums, doesn't come into play. So thank you. Long-term care insurance premiums. I'm sure that you've seen in the recent past that premiums for females have increased. Most importantly, premiums for single females. Well, about 2 years ago, it may be 3 now, Genworth was the first to do a very large study, and they realized they were charging the same premiums for a male and for a female. So for a 55-year-old, male or female, same premiums. However, 2/3 of the benefits that they were paying out, which is in the billions with a B per year, billions, 2/3 of the benefits were being paid out to women. So what does that mean? If I'm charging them both the same premium, then I'm 2/3 more likely to pay out on Abby than Alex, then I'm probably either, however you consider it, I'm charging Alex too much or I'm not charging Abby enough. And so insurance companies have gone to gender-specific pricing because of the amount of claims and benefits that are being paid out to females. And almost all companies have gone to gender-specific rates over the last few years. Genworth was the first, and then I think Mass Mutual and Mutual of Omaha, a number of companies followed very quickly. It's sort of like with airline fares or lowering or raising the price of gas on the corner where you have the 4 gas stations, one at every corner. Nobody really wants to be the first, but as soon as one person does it, everybody else sort of does it really, really quickly. They don't either want to be the lowest or the highest. So kind of like that with the long-term care insurance. So why? Why is this there? Well, we talked about mortality versus morbidity. Morbidity, men die sooner. If you're dead, you're not on long-term care claim. Realize that sort of probably an odd way to say it, but it's true. If you're alive, then you can be on long-term care. 80% of women are single at death. So if you're single and need long-term care, there's not someone else to help care for you. Statistics have shown that when there's a spouse in the home, people tend to stay in the home as long as possible, and people don't go on claim as quickly, or if they go on claim, they don't use as much of the benefits because, like parents, like spouses, we'll do almost anything for our spouses or our kids. We don't ask to be paid for it, you just do it. So when you have a spouse, somebody else in the home, they're doing all of that care for free. But when there's not that other person in the house, then I need help, or she needs help to care. Mom needs help, grandma needs help. When 80% of women are single at death, that means that 80% of women didn't have someone there to help them if they needed long-term care. And like this lady, she's really excited that she just won bingo. She's yelling, bingo! 72% of women will need long-term care after age 65. Sorry, trying to click to the next screen. There we go. And the ratio of men to women, or women to men in nursing homes, is 3 to 1. Again, sort of makes sense. When you look at a long-term care claims, 2/3 are going out to women. It makes sense the proportion of women to men in nursing homes is that much higher. So you have your financial planning practice, and you're in Georgia, and you have a client named Brenda, and she comes in to talk to you, and she starts talking about long-term care insurance. You say, that's good, something good to think about, Brenda, um, about the right age, single. It's probably something good we should start looking into and talk about. And being in Georgia, she's 59. Look at $185 daily benefit, 3-year benefit period, 3% compound inflation rider. So for Brenda, her annual premium, $31.25 with John Hancock, $33.25 with Mass Mutual, $4,004 with Mutual of Omaha. Why is there a little asterisk next to John Hancock? It's because John Hancock's newly designed policy is designed with a low initial premium that increases every year, but the policy can earn what they call flex credits, which are essentially like a dividend or a participating long-term care policy that hopefully as time goes on, claims experience is as priced or better than expected, that I can use some of those flex credits to reduce my premiums or at least keep them from growing. So that's why the asterisk is there. But the Mass Mutual and Mutual of Omaha are designed to be a level premium for life. But again, rates can increase in the future. So we look at that. John Hancock, $31.25, Mass Mutual, $33.25, Mutual of Omaha, $4,004. And you also have another client. His name's Brendan. He happens to be a male, 59. And you know what? He's thinking about long-term care, and he comes into your office. And he says, Mr. and Mrs. Financial Planner, you know what? I'm concerned about this too. And you said, well, I just did this for another client. And so let's look at the same policy design for you. Brendan's premiums, $2,166 with John Hancock. Mass Mutual, $33.25. Mutual of Omaha, $4,265. Now, hopefully some of you all noticed something odd about this. Remember, for Brenda, premiums just went up, up, up. Brendan decreased, stayed the same, decreased. Why? Mass Mutual still uses gender-specific pricing. So many times it looks like this. If we have Brendan who's single, they're $1,000 out of the running. If we have Brenda, many times Mass Mutual is going to be the best, especially when we compare to the more traditional level projected design premiums. Mass Mutual tends to win for single females. But you know what happened? Brenda was leaving the meeting. Brendan was coming in just to have his meeting. Their eyes met. They both realized they wanted to talk about long-term care, and a match was made. And so now we have Brenda and Brendan. And rather than having individual long-term care policies, they decided to apply together. Isn't love a wonderful thing? So they apply together. They can each get up to 30% premium reduction just by having a spouse. Why? It's not out of the goodness of insurance companies' heart. If they're married and one of them needs claim, or goes on claim and needs care, like I mentioned, Brenda or Brendan, will probably take care of the other at first for a while, delaying the period of time when the claim starts. And they'll do some of the care, and so they'll use less benefits right away because they're providing some of the care themselves. But I love the shared care rider on long-term care policies because it allows partners to share each other's benefits. 1 million women become widows every year. Age 59 is the average age a wife becomes a widow. And 70% of baby boomer women will outlive their husbands. So the shared care rider allows partners to share benefits. But when we look at these statistics, it's much more likely that the man is going to predecease the woman. And so she'll be left and possibly need care. This is part of what I like so much about the shared care policies. Brenda has her policy, Brendan has his policy. They each have benefits, they each have their own premiums. If Brendan dies and they have the shared care rider on their policy, Brenda gets to keep Brendan's unused policy benefits. Brendan dies without ever needing the long-term care benefits. They both had a 3-year shared care policy. Brenda now has 6 years of benefits. She has her 3 years, his 3 years. She gets to keep his unused benefits. But the premiums for Brendan's share of the policy drop off just like that. So now Brenda has 6 years of benefits with only her premiums. So at the point in time where there isn't somebody to help care for Brenda, if she needed it, she has a lot more long-term care benefits without any additional premiums. Sharon is 57 and lives in Kansas City. Let's look at these spousal riders, or the spousal discounts. $175 daily benefit, 90-day elimination period, 4-year benefit, 3% compound inflation rider. Her premium by herself, $36.80. But she has a husband, Mike, and Mike is good for some things. He's good for getting discounts on long-term care coverage. So they designed, instead of a 4-year policy for Sharon, they used 3 years each, so a total of shared pool of 6 years. They apply for similar benefits, and Sharon's premiums aren't $36.80. Combined, it's $46.81. So what did we do? We're able to get Mike 3 years of benefits, Sharon 3 years of benefits, have them be able to share benefits for about $1,000 more per year. It's almost, so what is that, 75% more benefit pool. And at the point in time where if Mike dies without ever using any benefits, then Sharon would get to keep his 3 years of benefits on the policy, and her premium share would be lower. So effectively, if Mike dies, the total premium Sharon is paying will be less than $46.81, and she still gets to keep all 6 years of benefits. A question, shared care, assume this means you have to apply with the same company. Yes, which means less flexibility in choosing the most attractive premium possibly, correct? It's possible. It's when you, let me answer the question. You can only get that 30% spousal discount if you apply to the same companies anyway. So the most attractive premium is probably going to be when you apply together. Sharon applying for Mass Mutual and Mike applying for Mutual Omaha, they're not really going to get many discounts. When they apply together, they're each getting a 30% discount. So in some ways, I can see the point that maybe it's by having the same company, it's limiting, but the premium discounts are so large by using the same company that it's always better to use one company. Now, what if Mike doesn't want coverage? He's got some group long-term care through work. He's just a stick in the mud. We're stubborn like that too. Maybe, just grumpy. He didn't look like a grumpy guy. Maybe he's just grumpy. Sharon wants that 4-year benefit period policy. If we add basically the smallest policy that we can for Mike, $50 a day, 365 elimination period, 2-year benefit, no inflation. Because there's a 30% discount on both of them, we have to add some premium for Mike, but then we get a larger discount for Sharon. Actually, it's not quite 30% because we had to add some premiums for him, but there is some discount. It actually saves about over $400 a year by Mike just getting this little tiny policy. Now, if Mike's like me, he may be stubborn, but he's also cheap. And so Mike will say, yep, I'll go through that because I'd rather save the $400 than not. And our last topic, annuities. And I'm not talking deferred annuities, variable annuities, anything that accumulates, but I'm talking about immediate annuities. Immediate annuities are designed for people with a long life. Because what we do is an annuity is the owner of the annuity gives the insurance company X dollars. And the insurance company says, based on your age, my mortality assumptions based on you being male and female and your age, interest rates, I guarantee that I'm going to pay you Y dollars per month for the rest of your life. If I have one foot in the grave and one foot on a banana peel, I don't want to lock up that money for a payment necessarily for the next 30, 40 years for the rest of my life. But if I'm in better than average health, and I think that I'm more of that 80% life expectancy or 90% rather than 50, immediate annuities can guarantee against running out of money if I live too long. So let's take Fran. Please. Fran, she's 64, has $150,000 that she wants to put toward a guaranteed lifetime income stream. She can get $782 a month for her lifetime, as long as she lives. She lives for 2 months, she gets $782 and the policy stops paying. She lives for the next 50 years, she makes it to 114. Policy will still keep paying her that $782 a month. Question, the annuity, is this with any inflation protection? This is not. This is just a flat income stream. Stan, he's 64, has the same $150,000. Stan gets $834 a month. And we just said, wait. Fran's in better than average health. Seems like, why doesn't she get more? Well, Stan actually gets more because at this point in time, the annuity company says, you know what? Stan has 2.9 years less life expectancy. So for $150,000, I need to pay Fran 2.9 years more than I do for Stan. But they both gave me the exact same amount and they're both the same age. So since I'm going to pay Stan for 2.9 less years, fewer years, I get to actually pay Stan a little bit more. Kind of makes, when you think of it, it makes sense. When you look at it the first time, we say women live longer, it's more favorable, healthier, smarter, should get more of a payout. Now, what about a joint immediate annuity? Okay, so how does that work? We've got Stan and Fran. They're both in love. And you know what says love? Nothing says love like an immediate annuity. So they take $150,000 and rather than doing it, putting it on just Stan's life or just Fran's life, they do a joint life that says pay a monthly premium for as long as both or one of us is alive. On that payment, $715 a month. And again, we might look at that a little sideways and say, well, but we were high sevens and in the eights for Stan. They should, if it's both of them, they should get about the same amount. It seems odd that they would get less. Well, when an insurance company is looking at this, they're looking at a female life expectancy and a male life expectancy. And there's always that fluctuation of, well, she could live a little bit longer than average, or he could live a little bit longer than average. When we have a joint life expectancy, we have he could live a little bit longer, she could live a little bit longer, and they could live a little bit longer. So the insurance company builds in a little bit more room for error that they're going to pay even longer on a couple than they would just Stan by himself or just Fran by herself. And so we covered women in life insurance, pregnancy and underwriting, women in disability insurance, long-term care insurance, and annuities. Oh, and I had a question about pregnancy and disability underwriting. And there's a number of different scenarios. So let's talk about a woman who is currently pregnant. A woman who's currently pregnant will have a pregnancy exclusion regardless of past history, whether she has had any pregnancy complications in the past or not. If she has complications with the current pregnancy, she will likely be postponed until she has delivered that baby and is back at work full time. So during pregnancy, that's sort of the general practice, and every insurance company is different. It's not an always, but it's a pretty good summary. If the client is currently pregnant and has no complications, there will be an exclusion, pregnancy exclusion put on the policy, which is reviewable after normal pregnancy and delivery. Reviewable means, can we go back, look at it, and say, okay, have the insurance company and the underwriter look and say, well, even though she was pregnant, there were no complications, went off smoothly, everybody's fine. Can we get this taken off so that in the future, pregnancies might be covered? And that's an option. If a client is currently pregnant and has gestational diabetes, may need to postpone if gestational diabetes is not well controlled. If it's controlled, there would be a pregnancy exclusion and probably a permanent pregnancy exclusion. If the client is currently pregnant and no complications but has had a previous C-section, there may be a pregnancy exclusion, which may or may not be reviewable, meaning may or may not be reviewed to be taken off. Question came in, are qualified immediate annuity payments different for the same individual when purchased in an IRA rather than a 401k? And the answer is no. The insurance company gets X dollars, and they're going to base it on, they're going to pay out benefits for Y number of years based on a life expectancy. So to the insurance company, whether it's qualified or non-qualified, they're indifferent how basically the insured gets taxed on it. If I'm the insurance company, I get $100,000, and either I pay it out as taxable or I pay it out as partly taxable or part cost basis. Either way, I as the insurance company got $100,000. I'm paying out X per month. So whether it came from a 401k, an IRA, a check, doesn't even, to the insurance company, they're looking at dollars in and then based on the person. All right, and I have a few more questions coming in, and some that I will probably respond to in the next few days because they're a little bit longer than I have a period or have enough time to talk about right here. So thank you all for tuning in. I really appreciate it, and we will do this again shortly in May. And in May, we're going to talk about disability insurance because May will be Disability Insurance Month. June, July, August, September, November, and December. We have fun webinars for this theme, for this year, with the theme Timing is Everything, and looking at what each month means. If you're not familiar with us, what makes LLIS different is that we're not your competition. We do insurance, we don't do financial planning. Our only clients are fee-only advisors. We do our best to save advisors time and your clients money. We pre-underwrite to avoid surprises, like with the gestational diabetes, knowing that a past history of gestational diabetes, American General is probably going to be the best application or a place to apply for the term life insurance. We have advisors tools and client tools all on our website. We're proud sponsors of a number of the fee-only organizations that you all belong to. We have specialists in life insurance, disability insurance, long-term care annuities, and hybrids. And when your clients apply and get coverage through LLIS, we keep your clients and you in the loop with our application information messages. And something that I think most advisors who are new to us are always surprised about is that we have 3 people here in our office who work just on policyholder service assistance. So changing beneficiaries, getting updates, new bank accounts, changing addresses. 3 people here who can help with that. And it says questions, but I've run out of time for questions, and a number of you have already sent me some really good questions. So thank you all very much, and we'll do this again in May. And if anyone has any questions, feel free to reach out, give me a call, email. Thank you all for attending.